What's going on, everybody? Michael and Coco here. You're watching the Daily Stock Market Brief. This show is on Monday through Friday. Today's date is October 16th. We're breaking today's show up into 4 different segments: the indices, the indicators, the commodities, and the currency. This helps us get a good picture to forecast and see where the market might be headed next. Let's get into it. Welcome back. Now, before we hop right into the charts, I just kind of wanted to show you, well, a chart that I didn't put together, but this is a very interesting tweet here from Hedgeopia. And this 3 weeks ago, basically, what I want to actually just point out here is look at the green. The green right there represents non-commercials, weekly net positions in the Nasdaq 100. So it's been high, it's been low, but then over here, this represents just a gigantic position for net shorts. And you can read right here in, where were we? Net short, 134.3 thousand in Nasdaq futures. So that was the highest since August 2006. This week, as of Tuesday, we are now net long 17.9. So in 4 trading sessions, we went from a record low to already positive territory there. So just a gigantic move. And what's interesting is when you look at the S&P 500, the Nasdaq 100, the patterns that were forming and the gaps that were being created that we were talking about, this all represented short squeeze. And we were talking about that on multiple episodes. So now what this is telling me here is, okay, and also he says it right here too as well, but now that we don't have this gigantic short position, the fuel for the squeeze could be just completely over. Another one of his tweets here, the green, I wanted to pay close attention to. That's a rolling 12-month cycle of net foreign purchase of U.S. equities. So it's only been this high in 2000, then the 2007, and then also right now. And what's interesting is this was the highest 12-month posting, it's 210 billion since 2007, but what happens there shortly after has been pretty crazy. So as you can see, that was during the dot-com bust, the financial crisis, and now we're also at those levels again. So not to scare you, but it is data, and data doesn't lie. Now, what's interesting, what's even crazier is, well, first off, if you look at these peaks, okay, that was, a big rolling, those were big peaks. But if you look over here, look where it was coming from. It was coming from just very low to a very, very sharp increase, which we did not see take place over here. So from way down here to way up here, that's a very aggressive move to the upside. So, it goes to the narrative. What I've been saying is you got to be risk off right here. You got to be very careful trading and investing in these market conditions. So we're going to go ahead and talk about the indices, and then we're going to get in depth on the indicators. We're going to start off with the S&P 500 on the weekly time frame. I'm going to move through them somewhat quickly because I feel like it, and the video's it's already late. It's already 6:30 p.m. Pacific Standard Time. Let's get into it. Okay, right now we tagged the upper Bollinger Band on this week, so we went as high as that, and that happened to be right where the confluence is of this megaphone pattern. And we're still now, we recaptured this trend line. Clearly it acted as resistance before, and then when we broke above it, we squeezed higher. So we're kind of just pinned between this trend line and this resistance. It's going to be interesting to see how this plays out. This candle, it's not quite an indecision. It's more bearish than anything, but the long upper wick tells me that this move could be somewhat toppy. Who knows though, there could be some crazy news that comes out to push our market even higher. But once we get into the breadth and sentiment indicators, you'll see my point why I say, you might want to be risk off. Here's the S&P 500 on the daily time frame. And really it looked kind of like a bull flag. We were monitoring this squeeze to the upside, which remember we were just talking about on those tweets. It looked like a squeeze, gap, 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 gap. There was a bunch of gaps. Then we filled 2 or 3 of the gaps, and then we kind of bounced from that point. It's normal to see that. And what's interesting about these past 2 days, we're sitting on the 5 EMA. So we closed at it 2 days in a row, right on the 5 EMA. The candle price action here it's bearish. I mean, it's an inverted hammer. Some people might call this projection to the upside a shooting star. You could ultimately also call this a bull flag still, right? So we have the pull, and then you kind of have this flag pattern. So we're going to have to monitor that. We have support at the 61.8% fib level. That's 3,444. And we also have the neckline of the inverse head and shoulders that we broke out of. And then there's this tiny gap over there, which adds more confluence to the support. So from basically 34.30 to 34.50 is just a massive chunk of support. If the bears capture that going into next week and they close out that, that would tell me, hey, we're going to be closing up these gaps down here as well. But, it's anybody's game at this point. It's a news-driven market. It's all about headlines. So, buckle up because things get bumpy during these times, as we've already seen previously. Here's it back on the daily time frame, but I just wanted to include the VIX right below it, and we'll talk about the VIX when we get into the sentiment indicators. But this gray box represents kind of a range of where I've been kind of just keeping a close eye on, where, it kind of gets toppy at the top of it, and then it acts as support towards the bottom. And right now we're at the top portion of that range with that inverted hammer candle. And if you look down here at the VIX, we were outside of the channel, and now we're kind of back in with a little bit of a hammer candle. So if we get movement to the upside here, I think it'd be likely to see us go test that 20 period moving average, and even potentially at the lower end of this range, which is around 3,300. So just something interesting that I want to point out. But right now I'm at that top area of that range. I'm not buying at this top area. I'd be more interested buying at the lower portion of the range. As far as buying a specific dip and for an intraday trade, or maybe a swing trade in a sector that has been performing. But looks like it's getting toppy, but that does not mean at all that this market can't go higher. Some people can call this, a short-term bull flag, and it was kind of a breakout, maybe a failed breakout, and other people call it a cup and handle. So there's bullish patterns, there's bearish patterns, there's bearish indicators and bullish indicators. It's anybody's game right now. It's just very hard to find direction right now. Here's the 2-hour time frame, and I'm showing you this just because I usually post this one on my Twitter account. If you don't follow me there, or on Instagram. I'm starting to create a chart look that fits into the Instagram kind of profile. So it's going to be interesting posting some stuff there, and maybe you'll do some stuff like, certain stocks. I'll do like 60-second or maybe even longer quick analysis on them or something like that. I don't know. I'm still thinking. Back to the subject. Bear flag, right? Other people said, this could be a bull flag breakout. And I understand. Bull flag breakout. Now it could be failing potentially, right? So, but I'm looking at it as a bear flag right now. And we broke down towards the end of the day. The bears, they did recapture the 5 EMA. So it looks like it can head lower. But you got to also understand it was OPEX week, right? And it's Friday. So with that said, this could just kind of be faking us out a little bit with all this other, with all these other things going on. So I can't take this as gospel right here. And, you got to look for areas of support that it might bounce from, which would be down here. I can see that. But it's very likely that, hey, something comes out and this was just a little, blip, and then we just start ramping up higher. So right now, when I'm looking at the S&P 500, there's not a trade that I want to take. The trade is going to be down here, or potentially another overextension move, which we talked about in previous videos. Here is the Nasdaq 100. We had this nice channel. We broke down through that channel, which also created a falling wedge, which is bullish. So it was bearish context, bullish pattern, broke out, nice looking, and now we formed a shooting star right here. We have an inverted hammer on a projection to the upside, but keep in mind we had one not last week, but the week before. We had a move to the upside, we had the inverted hammer, and we saw a big boost to the upside, right? So we never got confirmation is what I'm trying to tell you. So that very well means that we can still continue to move higher here. Now we are, we're not overbought. The RSI is very strong at 67.58, but it's very likely to potentially see this move into overbought territory. What would be interesting to me is if the market made a new high, but the RSI did not. That would be a negative divergence, which we talked about weeks and weeks ago on the market brief. And if that takes place, that looks really bearish to me. But we're sitting here at the 61.8. If, like I said, if we get confirmation and follow through, like say if we gap down and have a big red candle, that to me would be the evening star. That is a bullish or bearish, reversal type candlestick pattern. So yeah, big move to the upside. It's going to take a lot of work for bears to get this back down. Once we get into the indicators, like I said, it's going to be interesting to see, your thoughts on all of this. Here it is on the daily time frame, the Nasdaq 100. Very similar to all the other charts, to be quite honest. Yeah, we had the gap up, we went up, and then we came down. So kind of like dark cloud coverage right here where we gapped up and then we kind of closed halfway through this candle. Not quite halfway through. Not the greatest looking setup. Looks like it wants to head lower. Look, 5 EMA is this blue line. The bears have that. But just right below it, we got a gap, which can act as support. And then we got the 61.8 fib level. So the bears still got work to do. This is a very small celebration today for them. So I wouldn't take it, as a gigantic win. Let's go to the next chart, which is IWM. This is a Russell 2000 on the weekly time frame. I just want to point out, rising wedge. We broke down. It's the story all around, right? We broke down, hammer candle, we moved higher, and then we broke out through this pretty big area of resistance, a big move to the upside after we recaptured the 5 EMA. So this could be a trend shift. Now, seeing this kind of momentum in the Russell 2000 is interesting because this helps feed the narrative that the economy is recovering. Now, when you look outside your window, that's the last thing you see. But, the Russell 2000 showing strength in an environment like this is kind of interesting to me. Now, this could just mean it's, a bunch of hype and speculation, or it could be the honest truth that we are going to head higher. But keep in mind, we are also coming up against a massive area of resistance, is 65 to 67, or 165 to 167. This candle could be considered a hanging man candle. We saw this big move to the upside, and then, as you can see, the bears really took control down to this level of support. Once resistance is broken, it then becomes support, and then the bulls push back up higher. So bears intraday showed some strength. So this could be a hanging man, and we could very well pull back and potentially get below this horizontal, line of support. So if the bears close through this next week, I think that we can head lower. But if we could continue to hold this, maybe we might be consolidating to move higher. It's very possible. On the, daily time frame, that was the weekly. This is the daily. We're still within this channel. It looked like we're kind of breaking down, but then we push up higher. So we're still within the channel here. That's that blue horizontal line. That's at that 157 that we already mentioned. If we start breaking below this channel, which is 162 to 157, I think that we'll go test this level again and potentially break down. We got the 50 period though right below as well. So the bears got a lot of work to do, to say the least. On the 2-hour time frame, this is kind of interesting. We were mapping out this pink box as a level of support. The price pulled down because we saw the negative divergence, and boom, we moved up higher very quickly. But if you look at the RSI, it's not like putting in a higher high, right? It's still trending downwards from this high way down over here. So negative divergence still, even though we saw this big move up, I would still call this, a negative divergence. And with that said, if we start getting and holding below the 50, there's no reason why we can't come way back down into this area. Now, the 50 period sloping up, that can act as support, but keep in mind, we can also crash through it like we did previously multiple times. So kind of interesting. Here is the Dow Jones on the weekly time frame. Oh man, just this kind of range, this gray box is a range that we're in. The Fibonacci bounced right from that level, and that happened to be right where the 5 EMA is. That was the 61.8 level at 28,200. This also, it just is kind of it's indecision. The market doesn't know if it wants to go up or down. I mean, look at this. So the bulls, huge move last week. Boom, right? We closed right here. For the entire week of trading, we went up, we went down, we went back up. We finished up by 0.07, so total of 19 bucks. That's a very choppy week, to say the least, in the Dow Jones, right? So we had a high of 28,957 and a low of 28,181. So, an 800, 900 point swing right around there in a week's time, and we just landed right in the middle. So there's volatility, there's uncertainty. Didn't we talk about this last week? The markets are uncertain. This is why you want to be risk off or investing in sectors that look bullish or playing, pull back. So, and this is what I mean by it, like a full week of going like this, up, down, up, down, up, down. Let's finish in the middle. It is what it is. Here is the Dow Jones on the daily time frame. This was the inverse head and shoulders that every single index is doing. We broke out of it like every index did, and then it kind of formed like this channel that we were in. It was pretty tight. We broke down from it, and then we back tested it almost perfectly today and then formed an inverted hammer, shooting star, whatever, and now we can see some downwards momentum. Or we get a continuation of draft higher to this channel. It's very possible. The bears did not capture the 5 EMA here. All right, next section, we're talking about the breadth and the sentiment indicators. The VIX is the volatility index, and we've been tracking this inverse head and shoulders. I drew some new blue lines right here. It looks like a descending triangle of sorts, but not really. Maybe it just honestly looks more like just a pinned channel. I just drew it like this. If we start breaking above this trend line, that can just shoot us right into this neckline. It's very possible. So that would put pressure to the downside on the S&P 500. And when volatility increases, things could get pretty crazy pretty quickly. Now I want to talk about the put to call ratios. And now we've been using one that we've been calling like the sell signal or the warning signal. I'm going to get a little bit more in depth today. I'll go step by step. There is a few things that we're going to be looking at, okay? We're going to be looking at the equity side, which is retail traders. We're going to call this dumb money, okay? Not to offend anybody, but typically, when you look at this, they're typically buying at the wrong time and they're selling at the wrong time. So we're going to call the CPCE, the equity portion, dumb money. We're going to call the CPCI, which is the index, those are like the institutions. That's smart money typically. So we're going to call that the smart money. And then the CPC, which is the total, we're going to still kind of call that dumb money. And I'll show you why here shortly. But you might be looking at this chart and you're like, that doesn't look like the CPCE. You're right, it doesn't. I put a 5-period simple moving average on it and I added some envelopes because these envelopes can show us historic extremes. Now you could use straight lines, but this is a moving and flowing type of index. So what we need to do to kind of just ensure that at this particular point in time it's way overextended, we're adding envelopes to it. Okay, so I also inverted it on top of all of that just to confuse you more, but let me make it very simple. We have up here, this is calls. Down here is puts. Now we're talking dumb money, right? So when we get way overextended up here, this is dumb money buying calls. When we get overextended way down here, this is dumb money buying puts. What do I mean by that? Well, we're just looking at the CPCE right now. So right now we're getting we're in the envelope, right? We're overextended. We could potentially move even higher. So there is dumb money buying a lot of puts at this particular time. So a lot of dumb money buying, calls. Or a lot of dumb money is buying calls. And when a lot of people believe or are buying calls, that means, especially when it gets overextended, as I said, this is a contrarian indicator, that could mean that we're ending this whole cycle area of everyone being so bullish, and that is the time to potentially start buying quote unquote puts or going short or, taking profits. Okay, so now the next one is the CPC, and this is just the total put to call ratio. Now we use the 5-period moving average. I also inverted it, and we're going to go to my original indicator too. But first off, let me just show you this one. Okay, we're going to call this the dumb money because dumb money is in it. When we get into the over extremes, which we are not right now, that means that a lot of dumb money is already made their trades for the bullish side of things. Now, when we talked about that original tweet that we were talking about, the smart money, the hedge funds, they were super net short, and then boom, snap of the finger, they're making calls, okay? Just bear with me here. I'm trying to explain it as best as I can, but I'm not the greatest teacher here in the world. So we were very overextended here, a lot of call buying. If we start moving to here, that means even more dumb money, is it's more overextended in the call section, which tells me it's not the time to be buying calls. Now here's the CPCI. This is the smart money. That means the smart money, the CPCI, look how overextended this is. So this is smart. You don't need to be a contrarian on the smart money. I did not invert this scale. So we have two inverted scales way up here, almost moving all the way higher, and then we have the smart money way up here as well. They're all in alignment, which means to me, okay, this could be getting to a very toppy place. And it doesn't mean that there's going to be a crash. So I always got to preface that. But what it does tell me is the smart money right now is buying more puts and the dumb money is buying a lot of calls. So something to just kind of note. Now, the CPC, this is smoothed over a 10-period moving averages. And what we did was we added the sell signal down here based off historic terms. When it crosses below, that's a warning. When it crosses above, that's the quote unquote sell signal. So we are moving lower, and it can hold low for quite some time. Look at it over here. We went, for 2 months. So, and then it crossed above. And when it crossed above, we saw it move lower. So we got to watch out for this when it crosses above, because this is a sentiment shift. It's saying, all right, sentiment is way, way bullish, but now it's kind of, it's telling us, make sure that you're more bearish than you are bullish. So that's a whole lot of bearish and bullish talk, but I wanted to show you the CPC because I've been showing you this, but I wanted to layer it on with other elements that make up the CPC. So we're seeing smart money just ramp up, and we're seeing buying puts, which they're, hedging more than ever and buying a lot of put positions. And we're also seeing, dumb money buy a lot of calls. So what's taking place here? Well, the sentiment of the market, a lot of retail traders believe it's super bullish. And yeah, maybe hedge funds really do believe it's a lot bullish too, and a lot of institutions. But they're definitely hedging a lot more at this particular point in time, so it's something to take note of. Here is the Nasdaq 100 bullish percent index. We got, we moved just a little bit down to sideways. We got oversold. So what does this mean? Well, we saw this big ramp up to the upside. That kind of tells me, okay, well, saying that, it said that 85% of the Nasdaq 100 stocks are on buy signals, and that to me means we're moving into an extreme level, which could mean that we're going to be seeing somewhat of a pullback here. And now we saw, a little bit of a pullback. We're still pretty frothy right here at 67.88. Now it could bounce around and hold up in that range. Don't get me wrong. But if we start continuing to see a steady decline here, then that would tell me that, yes, the market is headed lower. Here's the Nasdaq 200. The Nasdaq 200R. This is basically taking the Nasdaq stocks, and it's showing you a percentage of the amount of stocks that are over the 200 period moving average. And just the other day, or this on the weekly time frame, we were over 90. So over 90% of the stocks were above the 200 day moving average, which means to me, the market's super bullish, but it could be overextended. And then what do you know? We saw this pullback. If you look at the hammer candle down here, it's an inverted hammer candle. So if we get a continuation move to the downside, it's likely that we start seeing this follow. So this was a very aggressive move, and now we can see somewhat of a snapback take place. So just overextended, got very, very frothy. This is the NI high-low. This is the NYSE high-low index. I use this also to kind of just get a good idea of what the market might be thinking. And, the market shot up pretty quickly here. This is them in the black bars right here. You saw them move up pretty quickly and then down and up. But then right here, what we're seeing is just massive fast spike from a low 56 to an extreme high 93.94 in the high-low index. So we have a lot of stocks making those new highs. Now the market has been pulling back a little bit. So to me, this says we're getting overextended and it's likely to see somewhat of a pullback, especially when you see these gigantic moves this quickly. Now it could hold up there, and this is a very laggy indicator, but if it starts being a aggressive move to the downside, like we saw here, boom, snap to the downside, you can see that it was setting up for this market to move lower. And you could see that stuff going back to as well multiple times. But like I said, it is a lagging indicator. Sometimes it's spot on. Right here, it peaked really, really high and then sharp down. And then look at what happened. Boom, we saw it pull down. So it's something just to track and keep a close eye on. Here, we were up here for a while. Then it pulled down very sharply. But the market kind of tried recovering a little bit. But then look how, that was the March big move to the downside. So to me, this looks overextended, and it has been. The next one I want to talk about is the NYSE. This is the McClellan oscillator. We're printing at 2.46, so positive breath. But we came from a very low point to a very high point, and now to a very low point as well. So if we continue to make a negative breath, this looks to me like it's 2018, where we saw this down pull, this uptick, and then we saw this down pull to make a double bottom right here. So if that's the case and we pull back down to these levels, I mean, why couldn't we go test 3250 and potentially even lower? It would make sense to me if the McClellan oscillator started moving down at that kind of speed again. Now, if it holds up here, that to me is bullish. But as you can see, we've been seeing this pretty steep decline here take place. So we will see, time will tell, time will tell. Now it's time to get into the commodities section. This video is kind of running late already, so I'm going to try to speed it up here. We're going to be talking about 3 commodities, starting with gold. Gold, we broke out, we broke back down, and then we kind of moved higher. Now we're just trading on this trend line. Look at this trend line. Just if you follow this down, I mean, this really just sinks right down into the election time, right? So it's very possible that gold is kind of just sitting on the sidelines, maybe draft lower, maybe draft sideways, waiting to see what happens and what takes place with either the Federal Reserve, the stimulus, or even potentially the election. But right now, as I see it, it's not on a buy signal, it's not on a sell signal, it's on a let's wait and see what happens signal. Silver's doing the same thing. This ascending triangle, got up here. I said, this looks kind of like a short position. Boom, crashed down, inverted hammer, now a doji candle, which is the indecision, still holding on this trend line, so that's nice. Will it break down? Maybe. I mean, coming from the context of being a bear pole and we're still below the 50, it might just bounce within this channel, coil up tighter, and then either make a breakout move to the upside, a launch pad, or we break down. There's, it just depends. It just depends. And right now, I just don't see it as a buying opportunity, and I don't see it as a selling opportunity at this particular point in time. I think that if we start breaking down, this 200 period moving average could be tested, and that could be somewhere around $20 to $20.50. We'll see if it does actually head lower. The next commodity is light crude oil, WTIC. We had this positive divergence, double bottom, saw it move up. We call that out. But in all honesty, it's still within this very tight trading range between 42, you can call it 44 if you want, and down here to 36, or you can call it 34 if you want. I just made it a little bit tighter. Now, the MACD, it is sloping up, which is nice, and it's been going sideways. There's a lot of things going on in the markets, and the consumption of oil is not near its demand as it once was due to the pandemic. So if things start changing, they could very well just send this commodity up a lot higher, which would put pressure on transports. When transports have to pay more money for oil, well, then they suffer. And the transport index right now has been just completely tearing it up for the last couple of months. So, like I said, trading sideways, we're going to just monitor this. Right now, it's at this top of the range, so it's not necessarily, looking all that great to me. It could be an inverted, that could be a hanging man, and then a even tighter coiled pattern. We are above the 50 period moving average, so, if we start breaking above this, maybe we do squeeze higher. We'll see. All right, last but not least, we're going to talk about the U.S. dollar. Here is the chart of the U.S. dollar. Showed some strength this week, which is nice. We had this kind of cup and handle forming basing pattern, and then we kind of broke out of this channel, and today was just an inside trading day, but we recaptured the 50 period. This still, to me, looks like, we can go higher. If we start getting above 94, boom, I think we're going to just quickly squeeze up. I don't think it's going to take much if we get above 94 to get up to 94.5. It's just a quick move from there to there, and the main resistance is right here at 94. So keep an eye on it, because the higher the dollar goes, it's going to put more pressure on gold, more pressure on silver, more pressure on assets. All right, guys, that was a long episode. This is probably not going to get out later tonight, or if it is, it's going to be like 10 o'clock Pacific Standard Time. Thank you for tuning in. I really appreciate it. Make sure to like and subscribe if you don't already, and I'll see you back here next week. And if you watch my weekly scan where I talk about all my stocks that my stock portfolio that I track, that is going to be tomorrow on Saturday.